Australia's unemployment rate is set to rise. Let's have a look. Good morning, everyone. Florian Heise here, and welcome to another episode of Heise Says. I had my stein of morning coffee, and I thought we'd have a look at this article about Australia's unemployment rate potentially rising, because it will be released later in the week. And it'll be interesting to see where it's all going, particularly concerning all the things I've been reading about the recession in our retail sector, and if any of the iron ore prices or dollar price changes will flow through to the economy in this month. So, wage and unemployment numbers set to pressure RBA to cut interest rates again. Reserve Bank Governor Philip Lowe's thesis that the economy may have reached a gentle turning point looks like getting a brutal reality check. What do you think, guys? Do you think it's going to get a brutal reality check? Let me know in the comments. Two of the RBA's greatest irritants, unemployment and wage growth, are updated this week, and if forecasts are correct, they are likely to exhibit a turn for the worse. The consensus view of market economists is the unemployment rate will tick up again, this time to 5.3%. February's 4.9% seems a long time ago. Now, before we go into any greater detail, I'd like to just call attention to a video I did from Roy Morgan, and it's called Australia's Unemployment Rate Hits 9.2%. Now, in this video, I compare the Roy Morgan data or methodology to, and we'll just jump to it here, to the ABS's methodology for determining unemployment. Now, it's interesting just the methodology that's used, the differences, and the different results they get. I think here you go, you've got unemployment and underemployment estimate as well, as opposed to just unemployment, and just the methodology that Roy Morgan uses compared to the ABS, which the RBA depends on, is quite different. I'm more biased towards this methodology, this approach. It makes a lot more sense for day-to-day people. It's less academic. I suspect the ABS and the RBA need to stick to their previous methodology to ensure consistency with what they've done in the past. Okay? Fundamentally, if you work 1 hour within that period, you're considered employed. That I think it's alone is an issue. It's really a big issue. So I'll bring that video up again, guys. Have a look at that if you want to look into it in greater detail. But remember, while they're saying here that it could go up to 5.3%, a lot of people are saying just double it to get a realistic representation of actual unemployment in the economy. So the RBA's ideal of full-time employment at 4.5% is now not even on the radar. 5% is as good as Dr. Lowe's economic modelers can see, and that's still years away at the extremity of their forecast vision. There you go. As for wages, the best anyone can come up with is that wage inflation over the first quarter as measured by the wage price index won't be much worse than any of the previous quarter's very soft results. The market has penciled in another quarter, 0.5% wage growth, barely enough to hold the WPI at 2.3% over the year. Data collected by the Attorney General's Department points to completed enterprise bargaining agreements delivering even lower outcomes in the first quarter. Well, I mean, guys, it's just going to get harder. Our dollar, if our dollar depreciates even more, I was talking to Stuart who ran for One Nation. He was saying in the coal industry, when he was ever negotiating about wage increases or this type of thing, they'd always be talking in US dollars, because that's how they sell their product on the international stage. The Australian dollar isn't really that important to them, but it affects all of us. So given the standard EBAs run 3 years, and the trend in the past 6 months, particularly in the construction and public sector, has been for a steep erosion in outcomes, weak wage growth looks locked in for some time. Well, yes. Yeah. What's the problem with EBAs running 3 years? Guys, everything that the government comes in and forces constraints, forces controls, it has a positive and a negative. Okay? That's just how it is. You've got to appreciate that. If you let the market run freer, you've got more chance of positive, but also the negatives get to run their course. I'm tending to lean more and more to the opinion that any intervention ends up causing worse negative outcomes in the long run, but we'll see. So the RBA winds back forecasts. Westpac's Bill Evans said there is little to suggest there's been a meaningful acceleration in wages. Wage inflation has lifted off its record low of 1.9% a year in June 2017, but running at 2.3% in March 2019 can hardly be described at breakneck pace. Yeah, it's nothing. It's nothing. It's not even real growth. We expect wage inflation to drift higher from here. Our forecasts have it peaking around 2.75% a year in late 2020. But given how well contained wage inflation is across the nation and between sectors, even this modest increase looks optimistic, with the risk meaningfully skewed to the downside. Well, there you go. Maybe if you're in the public sector and you're not part of the actual market economy, you can get these wage rises. But I think to all people, it's not possible. The low wage outcome are a big factor in the RBA continually upshooting its inflation target. It also puts a brake on household consumption and ultimately the entire economy. While the RBA's cuts to its GDP growth and unemployment forecast last week gained most attention, household consumption growth was also pruned back from 2% this year to just 1.5%. Not exactly the greatest news for struggling retailers. And just looking at the comments that I received from the video I did about the retail recession, the last video, more and more people are saying, well, my wage hasn't grown in a decade. Well, it's up 2% from 10 years ago. I can't spend any more money on crap. It's not worth it. Maybe people are waking up, buying these useless materialistic garbage. Really won't make much difference. Wait and see. With everything wound back, it was fairly obvious the RBA would also wave the white flag on the somewhat heroic punt on wages growth. The motivation behind this decision, which must be very disappointing for the RBA governor given his strong focus on lifting wages growth, is firstly due to the RBA's own liaison program, which shows that the majority of firms anticipate little change in wage growth over the next year, Mr. Evans said. I just think it's funny that the RBA thinks they can influence the economy that much. I really do. I'm losing all confidence in monetarist thinking. I think it's not as a finely tuned machine as people realize. They're like mad scientists trying to control the weather. It's not going to work how they expect. The problem is it's a negative psychological effect that affects consumer confidence. And, every time we look at it, it's going down. So it'll be interesting to see. We've got NAB releasing their business confidence today. We'll have a look to see where that's trending. That'll be interesting to see. So Dr. Lowe's basic proposition to the Parliament's Economics Committee on Friday was the economy would strengthen gradually after a run of disappointing GDP numbers. Isn't that what happens when you have a recession? I mean, come on. There appears to be little sense of urgency about the future of either the domestic or global economies, with the RBA happy to sit back and watch the magic of its June and July rate cuts work. The RBA board, judged that after having moved twice in quick succession, it was appropriate to wait and assess developments both internationally and domestically, Dr. Lowe told the MPs. However, the RBA's downgraded internal forecasts paint a slightly different picture. Slackness in the labour market, stagnant wages growth, and chronicle sub-target inflation. Another disappointing batch of unemployment and wage data this week is likely to snap the RBA out of wait and assess mode and back to the old cutting board sooner rather than later. So the market side of trade jitters. Wall Street traders thought it would be wise to offload risk ahead of the weekend, as another batch of trade-related comments from the White House left them somewhat confused and on edge. Central to the new anxieties is the fate of the next round of the US-China trade talks scheduled for next month. We're talking with China. We're not ready to make a deal, but we'll see what happens, US President Donald Trump told reporters on his way to a fundraiser. China wants to do something, but I'm not ready to do anything yet. 25 years of abuse. I'm not ready so fast, so we'll see how this works out, Mr. Trump said. The key US indices recovered a bit after the slump initial Friday sell-off. After a volatile week, they ended up roughly where they started. The ASX had a much rougher time, down almost 3%, its worst week since November last year. Futures trading points to a less than robust start on Mondays. So markets on Friday, there you go, down. Dollar, 67.9 US. Oh, heading down. Commodities are hammered. The escalating US-China tensions' impact on equities market have been modest compared to the pain being felt in trade-sensitive commodities. Over the week, oil's global benchmark, Brent crude, fell more than 5%, down about 20% from its April peak. The slide may well become more pronounced as the International Energy Agency, IEA, again cuts its forecast for global oil demand. Well, there you go. When you have a recession, demands for things decrease. The prospect for a political agreement between China and the United States on trade have worsened. This could lead to reduced trade activity and less oil demand globally, the IEA said its monthly oil markets report. Iron ore, and here's the big one, iron ore fared worse, down almost 15% for the week. Iron ore futures in the Dalian market have now fallen for several consecutive days. And remember, let's have a look here. We'll bring up, from the OEC, iron ore is 20% of our export, 20% of Australia's exports market. A lot of that's going to China, and a lot of our trade with China, which China's our biggest trade market, I think over 30% of that, or 60% of that is from WA, Western Australia. We've got a whole lot of issues in the Western Australian property market. So I wonder if it'll flow through. I really do. Dr. Morgan, who is the Executive Director of the Australian Council of Wool Exporters and Processors, said global tensions were weighing heavily on the market. All that good work was overshadowed by the increasing global economic uncertainty associated with the trade disputes between the US and China, and particularly the US and India. Rising tensions with Iran, the downward pressures on interest rates, and unknowns arising from Brexit, Dr. Morgan said. As always, in such circumstances, commodity prices come under pressure, except for gold, which moves up. Well, yes, how many of you bought gold recently? Gold and silver. I think we've got a few stackers watching my content. So, and here's another one that's quite interesting. Profits are a worry. So profits are heading down for a lot of big companies. Interestingly, the big French investment Societe Generale, SG, says the US is staring down the barrels of a recession next year. However, the trade war is more a catalyst in its analysis. The key factor is shrinking corporate margins and profits. If the US enters a recession in the next year, history is very likely to view it as a trade war recession, SG's US economist Stephen Gallagher said. Our analysis is that weak profit structures in the US has many companies much more sensitive to any shock, higher costs and uncertainty. So, trade tensions and tariffs are more damaging when margins are thin and companies are unable to absorb rising costs. I've been watching I started watching a video where a gentleman was talking about just share buybacks pushing up stock prices in the US, where, earnings or revenue hasn't increased, but earnings per share has, because they bought back a lot of the shares. So that's interesting. I need to look into that a bit more. So will the Federal Reserve's easy monetary policy come to the rescue? I doubt it. I really doubt it. Monetary policies have become more accommodative, and Fed officers are expected to cut rates further. Whether or not policy response is sufficient to forestall a recession remains to be seen, Mr. Gallagher said. And here's the key information that we've got coming out from Australia and overseas. So what do you all think, guys? What do you all think? Will we have another rate cut? Will we, get the RBA cutting rates more? Is unemployment as good as they're saying it is? I don't know. I'll just have to wait and see. I think it's all starting to come together, to be honest. If we have a recession in the US, how will that affect Australia? We're already starting to see some of the impacts in demand for resources, and we are a primary producer country. We're a primary producer country, guys. We're a tier 1 global economy, I'd say. Have a look up here. Anyway, guys, if you get a chance, I suggest you check out this the video I did,
particularly nowadays.
Roy Morgan.
I hope that would cap.
And there we go. Hang on. Have a check out this video here from Roy Morgan about just the differences in their methodology for unemployment rate to Australians, the ABSs, and I'll see you all later today. Take care, guys.